expenses. Well, regular Insight viewers recognize it right away as a valuable resource in planning and sustaining your retirement. She's Heather Foster, investment advisor and fiduciary. Today we want to talk about health insurance.
So what I want to talk about...
I was going to say, what about health insurance?
It's, of course, more related to the money side of things.
Yes.
You know, we talk a lot on the show about Roth conversions and tax strategizing, and some of the things, though, that we do is a ripple effect, okay? There's a cause and effect to it. So I want to make sure that if you got on the bandwagon with Roth conversions, or you're thinking about Roth conversions, or taking out strategic withdrawals, or maybe taking money out of your 401k because you qualified to take that $100,000 out without the penalty. Yeah. So there's lots of things that you may have chosen to do to create income surplus. So if you have additional income this year from any of those type of transactions, and you are on Medicare, or you're 63 and going to be on Medicare in a couple years, or if you are on the Affordable Health Care Act and getting a subsidy for your health insurance, any sort of income that's created from any of those type of maneuvers will cause potential issues for your health insurance premiums. So let me go down the road a little bit with this. If you're on the Affordable Health Care Act and you are getting a subsidy, subsidies are based on your income or modified adjusted gross income, which does include things like IRA or 401k withdrawals, Roth conversions, anything along those lines. If it's showing up on your 1040, you're going to potentially get pushed above the subsidy levels and have to pay more premium for your health insurance. And that kind of mistake is not a little mistake. I'm talking about if you go $1 over that subsidy charity, it can cost someone $12,000 that they have to pay back in the premium credits that they got, or have to pay an additional $12,000 a year for their health insurance. So these are not small mistakes. These are not things to overlook. So make sure that if you're looking or buying into the Roth conversions, which again, we talk about all the time on here, make sure that you're looking at the ripple effect, the cause and effect that maneuvers like that for tax strategizing can cause to your health. So the 63 thing, if you're the age of 63, you're probably going, oh, I got a few more years until I'm the age of Medicare, right? So if I did a Roth conversion at 63, you would think, well, okay, it's a big income year that year, but it's not going to affect me. I'm fine. However, Medicare additional premium is based on your income from 2 years prior.
I see.
Because they don't make anything easy, right?
So that makes a difference.
So if you're 63 and you did a large Roth conversion, you may not think, hey, this is going to cause me a Medicare additional premium, but they go back 2 years. So when you are 65, it's based on what your income was at the age of 63. So you have to think about those things. And obviously, if you're already 65, you should already be considering if you create a large tax year, 1 year for a Roth conversion, and you go over the level, you're going to pay an additional Medicare premium that year. So the Medicare premium, the additional premium that you have to pay, it's based on 2 years prior, and it's kind of a year-by-year thing. So as long as the next year you didn't have that higher income, then you won't get hit with that additional premium. But these are things to not overlook, because I've talked to people and go, hey, yeah, I'm looking at doing a Roth conversion, I'm thinking about doing this, and I'm like, hey, are you aware that if you do that, which is for tax strategizing and investment strategizing, it's now going to affect how much you're going to have to pay on your health insurance premiums, and making sure that those are actually, in fact, wise moves. Because I know if you did a $20,000 Roth conversion, but it ended up throwing your subsidy level off, and now you have to pay an additional $12,000 in health insurance premium, that was not a wise move. So making sure that you guys are thinking, when we're doing these strategies, that you're actually thinking about all the different cause and effects that they may have on other areas of your retirement planning or health insurance planning.
And it's good to have somebody look at those now, even if you already did it. So let's say you took that money out of the 401k when the CARES Act changes, you know, when it first came out. There may be some things you can do now
to push it back in.
Over.
Yes, you can do things like the 60-day rollover rule to push things back in. You know, there's things that we can do if we catch these kind of mistakes early enough to maybe help offset somebody getting pushed above that subsidy level on their health insurance, or the additional Medicare premium. You know, the additional medical premium isn't that big of a jump. It's not going to cost you too much. So generally, if you're going above that, it's more something you just want to be aware of, so that you don't get shocked that you're going to have to pay maybe an extra $100 a month for Medicare because of what you did back, 2 years prior to that. So,
well, these are all good reasons to have that second set of eyes. Look over what you've done. Give Heather Foster a call today, 234-2200, or check them out online, fosterfinancial.net. We'll be right back.